Hi, welcome to part 2 of chapter 4. Here we're going to be continuing and concluding chapter 4. We left off on internal rate of return, which is calculating a percentage of return while reflecting a discount rate. Usually can be thought of as the inflation rate, but in business terms, we might use something called the cost of capital. But since this is an investing class, we're probably going to stick with the inflation rate. So when we calculate a discount rate, this is going to be the rate of return that's going to look at the cost of the present value to the benefits it's going to provide this investor. So we're going to look at a single cash flow. So it could be an investment in a U.S. bond, a stock that pays dividends, but what we're going to typically calculate is what is the yield. So internal rate of return is going to be a yield where we're going to take out a discount rate, typically the rate of inflation. And we're going to calculate what the overall percentage return of the investment will be. So here's an example. So we make an investment of $1,000 that we expect to be worth $1,400 at the end of the 5-year period. What is the actual percentage return? So to calculate this, we'd use the Excel spreadsheet. Now, there are some textbooks. Most textbooks would also include information on how to complete this calculation using a financial calculator. Unfortunately, financial calculators are expensive and, most disappointingly, not utilized in business. So businesses use spreadsheets to calculate their returns, hold all their data, because spreadsheets are so much more functional and useful. Financial calculators are an outdated academic tool that we used to use when computers weren't available in the classroom or before everybody had their own laptop or computer at home. But now that everybody has access to Excel spreadsheet and their own computers, we try to mimic closer to what businesses do, which is using Excel spreadsheets. So if we use what we call a rate formula, we can use the rate formula to calculate our internal rate of return. So all we need is the cost of the investment, which we call the present value. This is the money we put up today. So this is a cash outflow. It's a negative amount. When we receive our money back at the end of a 5-year period, this is the payoff for the future value, meaning in 5 years, we're going to get $1,400. And then we have the number of years, which is 5. So if we put these inputs into the rate formula, so if you see the cell position here, we'll be able to calculate internal rate of return of 6.96%. Generally, for most of these chapters, I do a follow-up video using Excel to utilize and show how to calculate the majority of the formulas in the chapter. So look for that lecture to see the actual demonstration and be doing this in Excel, but this is just sort of a template of how you could calculate the internal rate of return using the rate function. Now let's look at another example. So here we have a present value applied to an investment. So this investment has income each year, and then we could calculate the present value of the income at a discount rate of 9%, and this will give us our present value. So if we add all the present values together, this becomes what our total present value of those cash flows are. Now, if we were to do it this is using 9%, if we were to do a present value discounting at 10%, we see that the overall present value is lower. So what we learn here is as the discount rate increases, the present value decreases. So think of it this way. As the inflation rate increases, the total amount of money you're going to have in real terms decreases with the increasing effect of inflation eroding the purchasing power. Now, another way to calculate internal rate of return, which I think is the easiest way, is just using the Excel function internal rate of return. So here you simply just click on the Excel function internal rate of return. And again, in a separate video, I'll show you how to do this step by step. But you're just going to highlight or include all the cells where there's a cash flow from cell 3 to cell 10, and this will produce a rate of return. So the internal rate of return on this particular project is 9.32%. And this would tell us that, yeah, this is a positive return. So if I make a return, the internal rate of return on this investment would be 9.32%. And this is an annual return. So an annual internal rate of return is 9%. So we're basically making about 9% a year on this investment. Okay, so the rate of growth. So if we want to calculate the actual rate of growth on an investment, so this is the compound annual rate of growth. So it's a change from beginning to end. So this growth rate, let's go to the next slide. We could use, again, the rate formula. So if we have, say we're trying to look at the growth rate of a dividend, which is going to be important in later chapters. If we calculate we take the dividends from, first let's take a number of years. So if we take 2017 in cell A12 and subtract it from 2008 in cell A3, we'll get the number of years. So this would give us our years. And then if we look at B3 as the present value and B12 as the future value, we're going to get an annual growth rate of the dividend. Now, and again, in a separate spreadsheet, I'll work up this. I'll show you how this is actually calculated, how to do the correct inputs in Excel. But basically, this is just the template we could use to understand the actual growth rate of a dividend. So the dividend, basically what it's saying is the dividend's growing at 7.85% per year, annualized. Okay, so let's switch over to risk. Now, this is the other side of the coin, where return would be on one side and risk would be on the other side. So risk is clearly the uncertainty of your return. How likely is a return? Is it guaranteed or is it very risky? So there's a trade-off between risk and return. And there's a relationship between risk and return where, as an investor, you want the highest amount of return possible for the lowest amount of risk. So if a project is going to be risky, you're going to need a lot more return than if a project is less risky to compensate you. And the idea is if you take on a number of these projects, hopefully your return overall will average out to be a higher return to compensate for these additional risks. So we can use diversification to sometimes help reduce the level of risk while maintaining a higher level of return. So as investors, we always want to look at how we can lower risk. So building a portfolio can help the lower risk. But if we're talking about a single asset, we're going to want to look at, say for a single stock, what are the sources of risk the stock is going to face as a single asset? And somehow we need to assess these risks and I'm going to go over steps in the decision process that are going to combine the return and the risk together. Now, the problem is that this is subjective. We don't have a definite formula that's going to give us a guaranteed rate of return, looking at all the risks and the possible returns, because we just don't know what the future, we don't know if our risk estimates are accurate towards the future or return estimates. But we do it anyway because we may be able to get pretty close, or we might have a good source of data that's going to be somewhat reliable. So let's look at a stock and think about a stock and think about the business risks. Now, when we break up two types of risks, it might sound the same. Business risk and financial risk may sound the same, but actually they're quite different. So business risk is really just tied to the risks of the business. So it's how likely is the stock able to make a return, a growing stock price. So now the business could be affected by many different things. The growth of the industry, it's the actual business model itself that we're talking here. Is the business something that's going to be destroyed through increased competition or through a massive change in the industry? Such as, is the the compact disc player going to be ruined by downloaded streaming? Yes, it is. So these companies have, the business risk of making CD players is very high, to the point where today no one's buying CD players and everybody's streaming their music or downloading it. Now, so there's uncertainty in your investment returns. So generally the investments, can have similar types of business risk, but business risk by and large is going to be related to that specific business model and the actual business that they're doing. And this can vary depending on the industry you're in. So some industries continue to grow and do better and thrive, and some industries will shrink. Now, financial risk is more about the uncertainty when a firm borrows money. So a firm can have a very good business. However, if they borrow too much money at too high of a cost, this could destabilize the firm. So the more debt a company takes on, the riskier they become because they have a greater financial risk or financial commitment to pay interest on that debt. So if you have a company that has a good business model, for example, there was a fast food company at one point called Boston Chicken, which was a very fast-growing fast food company that borrowed too aggressively and expanded too quickly. And it wasn't that their restaurants weren't doing well. The restaurants were opening up and making money. The fact was that they borrowed and overpaid for some locations and had so much financial interest they had to pay each year that even the growth of the business and the income that these new stores were making weren't more than the interest they're paying on the loans. So eventually they went bankrupt. They were later restructured, turned into Boston Market, purchased by McDonald's, and then later sold to a capital group. A capital group is an investment company that raises money and buys businesses. Okay. So we also have the purchasing power risk. So this is for a company, if you're buying components and materials to make a product, if the prices rise on those components, this is going to be a purchasing power risk. The risk that, changes in price levels are going to affect the business's ability to make a profit. Now, interest rate risk is the risk that interest rates increase. Because if interest rates increase, then it has one effect that businesses have to pay more for borrowed money, but it also has the effect that more money that could go into a stock investment is diverted into more of an interest-bearing bank account, savings account, bond. So interest rates do play a key role. Now, rising interest rates will certainly hurt bonds as well, because the new bonds will pay higher interest rates, making the older bonds less desirable. So that's a big source of risk. Liquidity risk is the ability to convert your investment back into cash quickly. So stocks are very liquid. Bonds are very liquid. Houses and real estate is less liquid. It takes a lot longer to convert it back to cash. You also have the tax risk. So this is the chance that new tax laws will be made, making capital gains and interest taxed differently. So a lot of countries do have favorable tax statuses for capital gains or interest made on certain bonds. But if these laws change, that could greatly reduce the value of your investment. One thing that's sometimes talked about that's really scary is taxing paper gains. So right now, say in most countries, if a stock goes from $10 to $20 per share and you haven't sold it, you haven't realized any gains, you pay no taxes. Paying taxes on the paper gains means that if your stock went up $10 that year, and even though you didn't sell it, didn't realize those gains, you still have to pay tax on that paper gain, which is, I think very difficult, because you may have a lot of paper gains, but you don't actually have a lot of cash to pay them, which means you would have to sell stock to cover your taxes on your shares of paper gains, which is overall would be a negative force moving stock prices down, or holding sort of like a gravity in stock prices. Now, you also have event risk. So this is something unexpected that could occur, like an earthquake, a tsunami, an event that's not likely to occur. It may only occur once every 100 years, but there's some sort of event that occurs that creates an environment where the stock prices are going down. Now, there's also market risk, and this is the risk that the overall market can go up or down, sort of a bull or bear market. So think of the market like a tide. As the markets are in a bull phase, the tide is rising and the water levels are rising, picking all the stocks up with it. And if it's a bear market, stock prices are going down and it's sort of like an effect where the tide's going out, bringing all the boats down. So if you might have a great stock, but if it's a bear market, there's going to be a decline based on factors of the broader market, where when stock markets go down, many mutual fund managers and investors may sell stocks and place it more into cash. So this has an overall effect of bringing most stocks down. So a stock that may have gone up, should have gone up 20% that year, maybe only went up 10% because the market characteristics are not favorable. And markets go up and down in total based on a lot of factors, political, economic, social, health-related issues of illnesses and changes in demographics. So these are risks that are going to affect the overall state of the market. So most stocks and bonds are going to face a combination of these risks. So looking at the total risk, you could see that you'd have to break it up into these different sources. And you could say that these are broken up into diversifiable and non-diversifiable risks, meaning that some risks, like a market risk, all stocks are going to bear, and some risks is only tied to a particular company. Okay, so how would we sort of measure this volatility or this risk? We can use the statistical standard deviation as a way of measuring the return volatility. So standard deviation is a statistical measure that you've most likely learned before, and this can be an indicator of an asset's risk, and we're going to measure the dispersion of the returns around that asset's average or expected return. So here is the shorthand of the standard deviation formula. Here's a longhand of that formula. And again, I'll have a separate video where I'll show you in a spreadsheet how to calculate this. But basically, what we want to do is we want to look at, first thing we're going to need is to look at the average return. So if we have the stock and we have the returns for a certain period of year, we can get the average return, or what we call R, with this little underline above it, above line, I guess I'll call it. And we can have a look at Target, American Eagle, Outfitters, and the average return. And you can see, if you look at these two stocks, which seems riskier? I think you would say the American Eagle Outfitters seems riskier because of the overall swings of returns between years. Looking at a general idea that even though there's a higher average return here, the fluctuations, which we can measure with standard deviation, would say that this stock overall is a little bit riskier, because you wouldn't want to own it in a year it goes down 28%, but you would like to own it in a year it goes up 86%. Okay, so if we take Target as our first example, and let me just make this a little smaller. Okay, so we could see if we take Target, here's how mathematically we would put the formula together. But basically, the way we work it in this textbook is we have column 1 would be the return. So let me just make it bigger so you can just see these numbers a little better. Okay, column 1, we take the return. Column 2 is the average return. So in the previous slide, we calculated the average return, which is just taking all of these returns and dividing it by the number of years, just a regular average. So we have the average return, which is the same for every year now. And we subtract, so in column 3, R to the T minus R to the dash here. So we take 30 minus 7, which is negative 37, or 42 minus 7, which is 35. So we just find the difference between column 1 and column 2. Then in column 4, we take this result here and we square it to the second power. So negative 37.2 times negative 37.2, we get this overall percentage here. And we can sum these percentages. So once we have the sum of the percentages, we want to find the square root of this target. So this would be the square root of this sum. And then we want to calculate the standard deviation. So we can calculate first the variance and then the standard deviation. So here to calculate the target variance would be the total percentage divided by n minus 1, which would be there's 10 instances. So since this is a population, we can do 10 minus 1. It's a standard. I gotta move this up a little bit so you can see this. This is what I'm talking about down here. So we have the total sum of the squares divided by 10 minus 1, which is 10 permutations minus 1, or n minus 1, which is part of the standard deviation formula. Then we find the square root of that number, and we get 21.3%. And again, I'm going to show you how to do this in the spreadsheet, and it'll make a lot more sense, easier to calculate. So this is just the first expression of that. But this, again, is stock target, 21% standard deviation. American Eagle Outfitters, using the same standard deviation, we get 38.8%. Okay, so remember those numbers, 21 and 38. So now let's interpret the standard deviation. The higher this deviation, the riskier the stock. So clearly, at a standard deviation of 38% is higher than the 21%. So the dispersion between the two companies is higher, meaning that the higher standard deviation is, the riskier the stock. And we'll talk more about the comparisons of these standard deviations, coefficient of variation, in the next chapter. Okay, so the risk of a single asset, we want to look at historical returns and risk. So the standard deviation is going to be a measure of risk through the accessing the historical data. And the general pattern of the investment with higher average returns are going to have higher standard deviations, which are going to reflect this greater risk. So again, we want to know, standard deviation is just one method to compare the risks between stocks. So this is a way we can put a number on the risk. But again, it's using historical data, which, since that's not a guarantee of future data, is not always the best indicator. So here's another chart, these are always, if it's hard to read in this presentation, you can always find the PowerPoints are always backed up on the course site, and the textbook always includes these same charts. But basically, if we look at annual returns and standard deviations of returns for stocks, government bonds, and government bills, we can see Denmark had a 11.4% annual average return. And this is, again, that 118-year period where we look at the annual stock returns in this period, 11.4%, and the standard deviation, 21.9%. And for the U.S., a similar 11.5%, but a lower standard deviation. Why is the U.S. standard deviation lower than Denmark? It might be because it has a larger group of stocks in its stock market, making it a little bit more diverse, a little bit less susceptible to the swings of a few individual stocks. Okay. Now, here's another slide where you could just look at the average return versus the standard deviation. So on the x-axis, we have the average return, and on the y, we have the standard deviation. So you can see, depending on the country you're in, you can kind of look at, most countries we see this upward trend where the returns are increasing as the standard deviation increases. And that's a good thing because you're getting compensated for that risk. Okay. Now, let me just move up this. Okay. So the other side of the coin. We continue with this nine slide series. So assessing risk. How do we know what the risks are? So we have to look at the general risk return characteristics of alternative investments. And are they acceptable amount of risk for the particular situation of that investment. So the level of risk is going to help us evaluate the return characteristics. Is it worth it? So if we have what we call an alternative investment, we're going to want to look at that trade-off between risk and return. So there's going to be hopefully a higher return for a higher risk. In general, U.S. government securities and deposit accounts are going to be low risk, low return. Why would someone want low risk, low return? If you're trying to maintain your capital and you say you're about to retire, you're retired, and you don't want to risk losing half your capital in the stock market during a stock market crash, you're willing to accept a lower return to also get the guarantee that you're not going to lose principal. On the other side, if you're younger and you have a long time horizon, say 50 years before you retire, you may look for higher risk, higher return investments because over time, the risks are going to mitigate over time, and things like real estate and individual stocks are going to have an overall better return, and the risks will be minimized through time. So on a yearly basis, the risks and the returns might be high, but if you continue with a diversified portfolio while you're young, they should balance themselves out and draw a much higher overall return. So this is why you have to look at when you're assessing the risks. And we're going to talk about some of these alternate investments, and they have different risk return characteristics and trade-offs. And this is one of the things that this course will help you with, and your own personal study should help you with as you're researching and looking into investments. You want to start getting knowledge in all the different investment instruments that you're able to invest in. So here's a general scale of expected return and risk. Now, this scale is somewhat subjective, so things can move around on the scale depending on different characteristics. For example, a mutual fund, this is assuming a pretty neutral stock mutual fund. But you can have mutual funds that are a bond. So if it's a bond mutual fund, the risk would be down lower here. Same thing with futures and options. Depending on the commodity, we denote where this is on the scale. So this is not 100%. So there's always arguments against some of these. But by and large, short-term government treasuries there are some that can be deemed risk-free. So if you have an inflation-protected treasury, that would be pretty risk-free. Then you would have deposit accounts and certificates of deposits in the bank. They're risk-free, but some banks can go bankrupt and not all your money may be insured. Then you have bonds, which are considered less risky, but some bonds can be just as risky as stock, and some bonds can be just as risky as some government treasuries. So it depends on the characteristic of the bond. But overall, bonds are less riskier than preferred stock. In future chapters, we'll talk about what preferred stock is. They're less risky than convertible securities. These are bonds that can convert to stock, and they're less risky than mutual funds. Mutual funds are less riskier than certain forms of tangible investments. See, this is lumping real estate and other tangible investments. So this would be gold, silver. So this is why this is probably the hardest to categorize where the risk is, because real estate is actually, I would say, less risky than mutual funds and stocks. But then again, it depends on what the real estate is, where it is. So it's all location, location, location. So it's very difficult. And real estate over the past 20 years have gone through some real booms and busts. So you can see how real estate could be riskier than some mutual funds. Then we have individual stocks, which are risky, but not as risky as options. The reason options are riskier than common stocks, even if those options are on or derived from the actual common stock, is that these expire. So at a certain point of ownership, the ability to use the option expires, where stocks don't expire. And similar future contracts. Future contracts expire, but they also use higher leverage. So options are leveraged. That's why they're more riskier than stocks. And futures are even more leveraged. And typically futures are not something an individual or small investor would work with. Futures are usually used by hedge funds, institutional investors, and large corporations. Okay. Moving on. So let's talk about assessing risk. So we want to look at, risk characteristics, different alternative investments, the risk return profiles, and we want to ask what's an acceptable level of risk for us, and how can we evaluate the way we feel about risk and our acceptable risk attitudes. We can kind of put this in three different categories as far as how you're willing to bear risk and how you think about risk. Most investors are going to be what I would say would be risk adverse, but there are some investors who are risk neutral. And these investors, they do not require a change in return to compensate greater risk. So they're basically sort of risk ignorant, meaning that they may own a stock, and at the time they bought the stock, the risk return trade-off was pretty fair, but certain things have changed and the stock has become riskier. They still hold on to the stock, and they don't really demand any greater dividend or any greater compensation for this increased risk. They just don't care. And this is typically could be the sign of an investor who just invests and really doesn't follow their investment closely, and is probably not a good stance to be risk neutral. Risk adverse is a better stance, and most investors take this risk adverse where you would require a greater return in exchange for greater risk. So if you're looking to invest in a stock and you have 5 stocks to choose from, if you're risk adverse, you would pick the stock that gives you the highest return in relationship to the risks. So say all 5 stocks have the same risk, you'd want to own the stock that has the greatest return. If you're risk indifferent, any of the stocks would be fine to buy no matter what the difference is between risk and return. If you're risk seeking, these are investors who are going to accept a lower return in exchange for a greater risk. This is what we call not the smartest investor. So you don't want to have a low rate of return and exchange for greater risk. It just doesn't make sense. This might make sense if you're into extreme sports and the thrill of risking your life in skydiving, bungee jumping, snowboarding. Even if that risk is small, it's still, you're seeking that risk. And so maybe it'd be more adequate to describe someone seeking a sports related risk, but not really a good stance in an investment. This sometimes occurs where people get into a speculative or gambling frenzy. So you'll see typically towards the end of a bull market, people, small investors especially, will start buying and selling stocks. They have no idea what the business is. They have no idea what the risks are. They just see a huge amount of momentum trading in the stock, and they go for it and they buy and sell the stock based on, the excitement of the momentum or the gambling of it. So this could graphically show you someone who's risk indifferent. Here is the required rate of return versus the risk. So we could look at positions X1 and X2 where risk increases from these two positions. Risk's going up. Maybe we'll say it's going up by 20%. It's irrelevant. But as the risk increases, risk indifferent seeks no additional increase in return. If you're risk adverse, you would want to get a proportional increase in return for that risk that's occurring. If you're risk seeking, you're actually looking for a lower amount of return for that increased risk. And you see how that makes no sense. And this would be, to me, a risk indifferent person would be someone who just has checked out of their investments. They made a bunch of investments a long time ago. They've checked out. They don't really care what's happening with the risks or their investments. And someone who's more risk adverse is a little bit more educated investor who's doing maintenance, maybe annually doing maintenance on their investments, looking at the changes in risks and changes in environment and saying, okay, this industry's dying or shrinking, the risks are greater, and the return is actually going down because people are abandoning this. Let me switch over to something more, has a better expected return and a lower risk. And so it's just about an investor's attitude. If you're the indifferent or seeking category, you probably would want to turn your investing decisions over to a portfolio mutual fund manager or a financial advisor. If you are adverse and you are experienced and you are knowledgeable, this might be something where you might want to do some of your investing as a more active trading. Okay. Let's sum it all up in this last slide. We're looking at the decision process, and these problems that we were talking about. Let's combine risk and return together. So if you're deciding between what type of investment to make, bonds, stocks, options, real estate, here's some steps that you should take to to combine risk and return. You want to estimate what do you think a realistic expected return using present value methods to project your return moving forward. And then best you can assess the risks of the investment, looking at historical statistics, mostly standard deviation, to better categorize this deviation and the dispersion of the deviation. How tight is it? Is it a higher standard deviation has a bigger dispersion of returns, and a lower standard deviation has a tighter dispersion of returns. So we want to evaluate this risk-return characteristics of each investment to make sure it's reasonable and tied to what we're willing to accept as a risk. And for most investors, the risk you want to think about is the risk of losing capital. So if the stock price goes down, you lose capital. But you're not going to be making a decent return in the stock market if you always play it safe. Okay, so selecting the investments that are going to offer you hopefully the highest expected return associated with the lower level of risk. And we'll talk more about this in chapter 5. But yeah, we want to figure out what company gives me the best returns at the lowest level of risk. This could be a market leader in the industry. This could be a top innovator in the industry. So we really would want to, and it's an art and a science combined. So we can use some mathematical statistics and properties of the company's returns, past returns, to get a better idea of where the company's heading. But we could also use the idea of reviewing the company's management, reviewing the management's track record, reviewing competitors against your company to get a better idea of the risks, the financial risks of the company, the business risks of the company, to better put us in a position to buy a company that's going to give us the best return over time. But none of these methods are 100% bulletproof because there's so much random factor or chaos in the mix that even when we make the most wise, well-researched decision, sometimes that doesn't work out. And some stocks you buy that are not well-researched or probably may look like a bad investment turn out to be a much better investment than we had predicted because situations and circumstances do change. And that's why investing is difficult, challenging, and a lot of people fail at it. And it's hard because when you fail, you're losing real money. So the more educated you can become. So doing well in the stock market, I think, is a combination of being well educated, taking courses in investment, reading books about investments, keeping up on changes in investments, as well as combining experience. Your experience trading stocks, your experience watching the market, your experience looking at how different changes in the economy or different changes in political landscapes affect the changes of overall stock markets. So your experience combined with your financial analysis should give you an edge in investing over just not doing anything at all. However, on the flip side of that, there have been studies that looked at experienced mutual fund managers making trades based on the best mathematical assumptions and experiences versus, somebody throwing darts at a board of stock symbols and just randomly putting a portfolio together. How do these two returns of these two types of portfolios, professionally managed versus randomly selected, how did they perform? These are things we'll talk about in later chapters, but it's interesting and confusing because sometimes the results are counterintuitive to what you would think. Sometimes that random portfolio generates a higher return than a professionally managed portfolio. So this is what makes investing in the short term frustrating and difficult. But by and large, some of the remaining chapters will talk about some strategies for long term to help ensure success. Okay, thank you for part 2 of this lecture. I hope you enjoyed it. I'll see you for chapter 5.